The autumn of 2008 will never be forgotten by the world's financial industries. On the 15th of September 2008, Lehman Brothers filed for bankruptcy protection. This sent shockwaves through the international financial industry, and the American mortgage system collapsed. The shock spread to Europe, where jumbo issues of covered bonds in series exceeding €1 billion dried up in several countries. In some cases, the consequence was government guarantees. Around the world, there was massive uncertainty, including in Denmark, where the refinancing of housing loans of nearly €50 billion lay ahead. The question was, would there be any buyers? And how would the Danish mortgage system withstand the international shockwaves? Well, the Danish mortgage system actually coped better than the systems in other countries. No mortgage banks went bankrupt. There were no government bailouts or guarantees for issuance of covered bonds, and the effect on loan rates was less significant than in the rest of Europe. That gives food for thought, because even though Denmark's a small country, it has one of the world's largest and most liquid mortgage markets, with a value of some €320 billion. Danish mortgage lending exceeds Denmark's gross domestic product of around €230 billion. It exceeds total bank lending of around €195 billion. And it's over 4 times higher than the total issuance of Danish government bonds of just under €100 billion. The financial crisis demonstrated that the Danish mortgage system is unique in an international context, and this is also demonstrated by its history. The Danish mortgage market emerged after the Great Fire of 1795 in Copenhagen. It originated from a desire to raise cheap home financing through joint liability, and not as a commercial banking activity. Bondholders have always received all principal and interest payments due. A mortgage bond is, and was back then, an instrument of debt secured against mortgages on real property. It's a negotiable security, and the price of the bond is determined in the open market. In practice, the balance principle means that when a homeowner raises a mortgage loan of, for example, 1 million Danish kroner, with a loan term of 30 years, a fixed interest rate of 5%, and quarterly mortgage payments in Danish kroner, the mortgage bank will raise the money by selling mortgage bonds worth 1 million Danish kroner with the same repayment and interest rate terms. When the mortgage bank receives the quarterly principal and interest payments from the borrower, the money is transferred almost immediately to the investors that hold the bonds behind the loan. This is called match funding. Interest rates aren't negotiated between the mortgage bank and the borrower. Instead, they're determined by supply and demand on the bond market. This is unique by international standards and doesn't form part of the mortgage system of any other country in the world. Jens Thomsen is a former governor of Denmark's Nationalbank, the Danish central bank. He emphasizes the importance of the balance principle to the Danish mortgage market during the crisis and to financial stability in Denmark.
It's important for financial stability that there is a direct match between the loan and the bonds. It reduces the risk of the mortgage bank to a credit risk as long as the bond is issued.
The balance principle limits the possibilities of Danish mortgage banks exposing themselves to interest rate, foreign exchange, liquidity and option risks. However, mortgage banks are always exposed to the risk that borrowers fail to repay their loans. Danish legislation lays down strict conditions for mortgage lending. Mortgage banks are only allowed to finance loans by issuing bonds according to the balance principle, and mortgage banks are not allowed to accept deposits. Mortgage banks must have adequate capital reserves to withstand losses if borrowers fail to repay their loans. In the event that a mortgage bank goes bankrupt, bondholders' claims will always be covered first. But that situation has never occurred. There are loan-to-value limits of 80%, the observance of which is monitored by the Danish Financial Supervisory Authority. If a borrower fails to pay, a forced sale may be realized in the course of about 6 months. Danish mortgage bonds achieve the highest international ratings for their creditworthiness and are characterized as highly secure gilt-edged securities. They're traded at attractive prices, which has a positive effect on the cost of mortgage loans, which also benefits the borrower. One of the major institutional investors in the Danish market is LD, which manages €7.1 billion on behalf of its 1 million members.
As one of the larger Danish institutional investors, we have invested about 1/3 of our total assets in Danish mortgage bonds, and that is because we see that asset class as having an interesting risk-return profile with a slightly higher return and almost the same risk as in government bonds.
The balance principle forms the basis of a market-based prepayment system, where borrowers can prepay their loans at any time by buying back exactly the same bonds that were earlier issued to finance their loan at market prices. This is unique in an international context. Mortgage banks, however, cannot terminate mortgage loans prematurely. The economic advantages of refinancing a loan may be either lower mortgage payments or reduced debt. For the Ekelund family, the transparent market has meant a great deal.
By looking at the newspapers and watching the television, we could see that there possibly was an advantage for us to change the loan that we had in a real credit institution. And we went in and we asked them to tell us the different options that we had to choose from. And we came home and we did a bit of research and we found out that if we changed the loan that we had, we could not only have more money for us each month, but we could also pay off our mortgage of the house at a smaller cost than it was having a fixed interest. So for us it was a huge benefit. And we were also able to use the money that we saved by not paying the high amount of interest rate, by actually paying off our car loan. So we used the money and we saved it up and we had a more expensive loan paid off.
The right to early repayment is also crucial to healthy competition between the different mortgage banks. Most homeowners regularly follow the development in interest rates. According to estimates, around 115,000 Danish homeowners obtained a reduction in their regular mortgage payments after having refinanced their loans in 2009. All in all, this is a reduction in mortgage payments of around 5.3 billion Danish kroner a year. The Danish mortgage system also provides equity protection to borrowers with fixed-rate loans. Higher interest rates usually lead to falling house prices. At the same time, this leads to a fall in the price of the fixed-rate bond on the market. This means that the borrower can convert their loan to end up with a lower debt, and this protects homeowners from becoming technically insolvent. The EU Commission's White Paper on the integration of EU mortgage credit markets says that in Denmark, the right to early repayment is directly linked to the refinancing system. This is unique in Europe. The right to early repayment does not originate from the law itself, but has been developed by the market. Peter Engberg Jensen is Group Chief Executive of Nykredit, the largest mortgage lender in Denmark, and he's chairman of both the Association of Danish Mortgage Banks and the European Mortgage Federation. He emphasizes that mortgage banks have valid incentives to offer homeowners the best possible advice, for example, about refinancing.
There are legal rules when it comes to advice, and naturally we have to follow the legal rules. But on the top of that, we have very good incentives, meaning that we keep the loans on our balance sheet. So if I offer a loan to you, I'm in a situation that I get a loss if you can't pay me. So it means there is an incentive for me only to give loans to good customers. And on the other hand, you are personally liable, meaning that if you know that you can't pay, you will not take up the loan. So we will not get into the same situation as you saw maybe in some part of the American market, where customers took up a loan just to take it. They knew that they couldn't repay, but it didn't mean anything to them because they were not personally liable. We have very good incentives, and it means that the risk of the whole system gets lower.
The fact is that the Danish mortgage system provides a unique balance between flexible and safe financing of the Danish housing market. And that has far-reaching positive implications for the economy as a whole.